Hello and a warm welcome to this quarterly update from SKAGEN Kon-Tiki. Portfolio manager Hilde Jenssen has joined me in the studio, and Hilde, congratulations on a very good quarter.
Thank you so much, Ole. It's been a wonderful quarter in terms of our historical results. It's been the best quarter in almost 4 years, so we're very proud and happy to be standing here and telling you all about it. It was actually an interesting start to this year. If you recall, in the beginning of the year, there was a lot of doom and gloom about emerging markets. And also, most people thought this was not going to be a particularly good first half of the year. The first quarter, we saw a little bit of volatility and fluctuations, but the second quarter has been much of a contrast and very, very quiet. You also saw a lot of the main markets rebounding and doing quite well in equities. And our portfolio did well as well. And I think one of the key issues that I wanted to share with you, and we put together this graph which shows you the volatility of the different asset classes during the second quarter. This particular graph shows you the currencies, equities, and rates, as well as commodities. And you basically have to go back to 2005, 2006 to find the same historically low volatility level. That also means that equities did quite well during this time period, which is typical. With low volatility, usually equities tend to increase. And behind all this, this trend, we find that there are several sort of key trends that happened during the second quarter. One of them was that China, main growth driver in the global economy, is much more on a stimulatory pathway, if you will, in the second quarter vis-a-vis the first quarter. So just 6 months ago, you see a main shift there, which is interesting. You also see an economic recovery in Europe. And we see US is coming out of hibernation after a long, hard winter. So that is also boding well for US equities. We also see a low rate environment, which seems to persist as long as inflation stays low. And in this low rate environment, we actually saw some of our companies take big advantages of that, refinancing their existing debt into more favorable terms. And some of them actually getting into new financing arrangements that's saving them 300 to 400 basis points a year, which is significant. So with that, we also saw stabilization in margins, which is something that we keep looking for.
Mm-hmm. And that sort of opens opportunities for you, the low interest rates regime. Yeah. Exactly.
So as the companies take advantage of these lower rates and refinancing their debt, with that comes a re-rate in the stock price as margins stabilize and improve. However, we haven't quite seen the re-rate in some of these names yet, which has given us an opportunity to increase some of the sizes in these holdings. Mm-hmm. So we think there's upside.
Interesting. Interesting. Let's have a look at the results.
Sure. During the second quarter, the fund was up 8% vis-a-vis the market, the index at 7.4% measured in euro terms. And we made up some lost grounds in the first quarter, both in the absolute and relative terms. And I think moving on to the major markets, looking at, there were sort of 3-4 key markets that did very, very well in the second quarter. Turkey, India, and Russia, as you see at 16%, 15%, and 13%, did very well. Russia was interesting. Russia had a tough first quarter, but saw a nice rebound in the second quarter as the political tensions abated with Ukraine. Now, at the very bottom, if you sort of sticking out a little bit as a sore thumb, is Ghana. Ghana was down 20%, but it's worth noting that the majority of that decrease is because of the depreciation of the cedi, the Ghanaian currency, against the euro. So And that is a reflection of the fact that the government is battling high deficits and also trying to get a handle on this high inflation, which is trading at a four-year high. And Ghana also notably is the second largest economy in West Africa. So we don't have a huge exposure to Ghana. We're below 1% roughly. And then I'm counting also the companies that are not necessarily listed there but have exposure to the market. But we think Ghana in the long term will see a nice rebound.
Okay. Contributors then?
Yes, well, our tried and true Hyundai motor seems to be motoring on in terms of its contribution, doing very, very well. Again, we're invested in the preference shares, both in Hyundai and in Samsung Electronics, which is also on the list. Samsung is interesting. There we saw a slowing momentum in the mobile handset business, but that is being more than outweighed by investors' growing anticipation of the generational shift that's taking place within the company, and also looking at the potential for increased and improved corporate governance in that company. So we see a lot of upside. The shares are trading at 5.5 times earnings, which is very cheap, we think. And the discount to ordinary shares is roughly about 20% at the moment. And we also saw State Bank of India, which is an interesting contributor. State Bank of India was probably one of the least popular names in our portfolio going into the year. The company did a capital raise during the first quarter, and Kon-Tiki participated actively. We significantly increased our position in the stock. The stock year to date through June of the second quarter was up 50%. So we benefited significantly from that move. We also saw during the, well, we see further upside, and the reason it's still in the portfolio and still significant weight is it seems to be very under-owned among institutions still. So we do think that there is potential for the stock to appreciate further. On the other side of the ledger, in terms of detractors, we see a Great Wall Motor, who had a tough quarter. I was actually at their annual shareholder meeting during the second quarter, and where they announced that their Model H8, which is their new SUV that they talked a lot about, unfortunately had to be delayed in terms of shipping. And the latest update there is that they had found the reason why it was delayed, and the component is being replaced, and hopefully shipments can commence during this year, towards the end of the year, which is good news. We think there is lots of upside in the stock. It's trading at 7 times fiscal year 15 earnings, which we think is inexpensive. So we think that that will come around, and hopefully we'll be seeing it on the other side of the ledger soon. Of note, other two names that had particularly weak quarters were Banrisul, and that's a Brazilian savings bank, and also the Egyptian OCI NB, which we largely expected those results for the second quarter. In terms of I would say on the whole, in terms of performance, the performance so far to date in 2014 slightly exceeded our company's performance during the same period in 2013. And as I mentioned, part of that has to do with the stabilization of the margins. And that's something, those are good signs that the market and investors like us are looking for in terms of investing further into these companies. So we took the opportunity to increase our positions in the companies that we saw, particularly taking advantage of the refinancing options that we talked about earlier. Bharti Airtel, Indian company, Lenovo, Vale, AirAsia, and GTL Poly are some of the names. The other issue in the second quarter to to maybe mention is solar stocks had a particularly weak quarter. And that had to do with Chinese shipments and activity being lower than anticipated, but that seems to be turning around during the third quarter. And our long-term hypothesis is still going intact and going strong. In terms of positions that we sold out of was Pacific Drilling, and also the TSKB Turkish company. And that had to do with limited upside visibility on those companies. Nothing fundamentally wrong, but just putting capital to work where we think we're getting better returns for the risk that we're taking. In terms of new ideas, we're excited to announce we entered into 4 new positions during the quarter. And one of them is Hitachi, Japanese capital goods company that is undergoing a restructuring that we think the market is not necessarily seeing the potential, and therefore the stock has room to run. And we're also excited about Massmart, which is Walmart's tool and controlled by Walmart, a wholesale and retailer in South Africa. And they're doing quite well and taking great advantage of improving conditions there. We also entered into Golar LNG, which is a Fredriksen-sponsored company, and we think that company is in an interesting position to potentially take advantage of the LNG market through its regasification technology. And on the European side, we entered into Casino. That's our 4th new idea.
Not gambling, though.
No gambling. It's a grocery, multi-format grocery store chain. And they have about 60% of their sales in growth markets, including Latin America, Africa, and Asia. And an interesting story, great track record, and I think the story is still about to unfold, and we're excited to be able to enter that. On a final note, we also added to our position in Heineken, and the rationale there is that European companies, and that goes for Casino as well, which is a French company, European companies on the whole are going to have an easier comparison in terms of their currency translation. So we think that we also added on to our position in Heineken, and it's summer, so people drink beer. So, and those are the main changes in the portfolio.
Very well. Shall we have a look at the largest holdings?
Yes, and this is an interesting slide. Just the thinking about the portfolio as a whole, as you know, we try not to be political pundits or trying to anticipate rate moves, market moves, or where the wind is going to blow tomorrow. I think we're very bad at that. But what we do focus on is to listen to what companies are telling us in terms of where they think the opportunities are and where the challenges might be. We also listen to their vendors and their clients, and not the least their competitors. And I think based on that is how we put together this portfolio that you see a portion of in front of you. The one thing of note, I think, is India here as more of a top-down view on Indian companies, and that's a reflection of the real shift in sentiment in India since the elections. And as a result, I think a lot of the country risk is taken out of India. We've taken advantage of that and increased our target prices accordingly by 20 to 25% for our Indian companies. So that is again reflected in this table. We think the portfolio is well priced, currently at roughly 8 times 2014 earnings and a 1.2 times book with a 39% upside. So we can't guarantee smooth sailing for the rest of the summer or into the third quarter, but we think we're well positioned to weather some hefty winds.
Great. Thank you very much, Hilde.
Thank you, Ole.
Before we end, I would like to remind you all that we have a brand new market report published on our website, so do have a look. And we wish you all a very nice summer. Thank you very much for watching.